All right. Thank you. Thank you. Thank you to all of you. Okay, so I'll make this one as smooth as possible because already is already lagging because of how I started. My apologies, please, guys. So today, so see, honestly, I today, was it today? Yes, was it today? Yeah, today somebody told me that I shed more light on Silver Bullet on on Silver Bullet, and I was surprised to hear that because, guy, I don't know what Silver Bullet is. He said one of the videos on my YouTube should like made him to really understand the Silver Bullet strategy. So I'm like, okay, guy, I honestly don't know what Silver Bullet is. So maybe it's the liquidity sweep, because I think that's like the only major strategy I have put on my YouTube. So maybe it's liquidity sweep on London session. I don't know, but honestly, I've been trading that thing for like since like almost 3, 4, 5 years without even knowing anything about ICT. So is not from ICT. So if you learn something from me, this is good to hear. All right, but trust me, it's not from Silver Bullet. I hear Silver Bullet a lot. Some of my mentees, they use it. They use the Judas swing, Silver Bullet, and all this. In fact, what I do from time to time is I just try to look at some of the ICT approach, right? So that I'm not, I'm not aware of what is happening there. But with where I am, really, I don't need to begin to, go and seek anything anymore. All right, except maybe when I want to teach something, I feel like, okay, let me just see. Yeah, thank you. Let me just see what everybody's seeing and what everybody's doing, so that I'm not talking out of context completely, or just perceive what is happening out there, right? And I do that a lot. Okay, so I just want to see what's happening, and I'm going to explain liquidity my own way. And I am letting you know beforehand that you don't come and text me and say, oh, the way you explain it is not like that. There is a market maker somewhere, or there's no market maker anywhere, or there is algorithm, or I don't care. I don't care. Don't tell me. This is my own understanding. This is the way I use it. All right. And I'm giving you for free. So I don't care about your opinion about, oh, this is liquidity. You don't even know. Let me just tell you the truth. You don't know. None of us know. 95% of what we do is just based on probability, and you know what you know because maybe somebody told you, yeah, this is how it is, and maybe you tested it and you like it and it works for you. That's fine. So don't insult someone else, or don't say, oh, this person doesn't know, or this other person knows, this one doesn't know, or this one don't know what he's saying. This is my own explanation. First thing I need to teach you is what is liquidity itself. You need to understand it. What does it mean to say that someone is liquidated? All right. What does it mean when we start to say, oh, you have been liquidated? All right, so the topic today is liquidity. So what does it mean when we say the guy is liquidated? See, some things, for you to understand what liquidity is in a very simple English, right? Something can be liquid or it can be illiquid. All right, I don't know if there's a word as illiquid, but let me just use that for... See, liquidity is money, cash. The most liquid, almost everything is liquid, right? But some things are more liquid than the other things. All right. So I think cash is the most liquid because our society is so organized that there has to be a legal tender. There has to be something that you use to get anything. So an example of something that is not liquid, I can say a car, or maybe your goat, or your ram, or your house, or your yacht, or any other thing, your possession, your land, right? They are illiquid. Why? Because if I want something, let's say I need something like, what do I need? Let's say I want to buy a microphone. I cannot come to you and say, give me your car. for me to get the microphone, what will I do? I'll come and say, okay, I'll give you money, or I'll give you money so that I can buy the microphone. So what I'm trying to say is, for movement, for the market to move, liquidation has to occur. For price to move from point A to point B, A guy has to liquidate. If A guy does not liquidate, B will not be attended to. So if we want to get to B, that's why you see sometimes there are gaps, right? Because the market is in a hurry to get there. So it leaves some orders behind. I'm going to get to that in a minute. So see what I'm saying? Cash is the most liquid form of everything. Exchanges can only be done at cash. That's why you see when a company liquidates, when they tell you that a company has been liquidated, right? What does it mean? For them to liquidate and move, they need to sell off their properties. They cannot say, oh, I will use maybe they have debts to pay. They have maybe court cases to settle and all that, right? They will go back to their building and their assets, right? All of these are liquidity, but they are illiquid. They are not as liquid as cash. So when you hear that the company has been liquidated, what does it mean? They've sold their building, sold their cars, their assets and everything, right? Their land, their properties, their possessions. They've sold it so that they can get what? Cash. So we now say this company is what? The company is liquidated, right? That's what we say. So cash is the most liquid form. That's why you can hear some people who say, I'm not liquid at the moment, because they're trying to tell you, oh yeah, I have money. Big men use it as an excuse a lot. If they don't want to give you money, they say they are not liquid, that their money is tied up in the container, in the high sea, or in investments. All right, that's the excuse they use to tell you, okay, I'm not liquid. So if somebody says he's liquid, he probably has a bundle sitting in his house. So he's liquid. He can flow. That's what we mean. So liquidity is your ability to flow, to move. Liquidity essentially means ease of exchange. All right? It's the ease of exchange. All right? So what is it easy for me to exchange a car if I need maybe a goat? It's not easy, right? It's not easy. So what can I use to get a goat that is going to be easy for me is what? It's cash. All right, so this is, and why I'm saying this is because that's what is happening. Liquidity is important. For price, for you to get what you want to buy at a certain price, I need to get liquidated. All right, and you may perceive it as, oh, it's bad, it's good, it's not. But if somebody doesn't get liquidated, the market will not move to another point. It's very important, right? If cash is not available, there will be no movement. Why do you think in some sessions, the volatility is very low, and in some sessions, the volatility is very high? Why? Because, and then if you see the sessions that are usually like Asia sessions where there is no movement, the days where you see a lot of movement, right? A lot of volatility. Those days are the days where there is news. And think about it, a lot of people want to trade the news. So they will set their alarm maybe at 2 a.m., for maybe NZD, AUD news and all those guys, right? Sydney session, of course, is encompassed into the Asian session. You see, these are the days where you see maybe big trends because there's been a news release, a red folder news release by midnight. All right. So what do you see? That's when you see sessions that don't have too much money, sessions that are not very liquid. That's when you see them being liquid. Why? Because a lot of people have come in, a lot of orders have been placed, a lot of people are interested, and then there is a release of news, and then everybody's buying to a certain point. So that's why you see that is the period or the times mostly when Asia is trending. But most times you see that Asia usually is flat, right? It's flat, it just goes up, comes down, doesn't go anywhere. Even if it's trending, it's a very, very weak trend. All right, it's a very weak trend. So what I'm saying is that the participation here is lower compared to, of course, New York. you know London, and then you know the cross between New York and London. There's a time when the traders on New York are still are coming in, and then the London traders are still seated from from when the banks open in London around I think 7 o'clock, right? From that time, 7 or 8 o'clock, right? From that time, what you see is that there's a lot of volatility. Why? Because cash is introduced. So there's liquidity for the market to flow more. And then what do you see when at around 1:30 p.m., right? I'm using, all the time I'm using here is W80, right? That's Nigerian time. Mostly BST, although now BST has to be +1 because of the difference. All right, because there's been a slight difference there. So, but if you're coming from the other parts of the world, it's generally GMT +1. All right, so that's the time I'm using here. Okay, so if you're in Nigeria, you don't need to bother. Every time I'm saying here is Nigeria. Okay, so I'll go back, right? I'll go back. So see what I'm saying here. Very simple. See, before the banks will close from, let's say, 8 o'clock, it will be around, let's say, 4 p.m. or 5 p.m., right? This is normal, even in Nigeria, right? 4 p.m., 5 p.m. That's when the banks will close. London will open. London is about 6 hours ahead. So around 1:30, this is when their own banks is opening. That's 8:30 a.m. in the morning for them. So that 8:30 a.m. coincides with what? With London. So London are still seated, and then New York is coming in. So what do you see? There's a lot of influx, right? There's a lot of influx. And then this influx is what is cash. And then this cash is what is liquidity. All right, there are some set of guys, I just, they say that, oh yeah, that a time is important for liquidity. Okay, because the market cannot talk about liquidity if time is not involved. All right, and I just say, okay, so what about people that are not looking at, you can have this argument, and I'm not trying to say, I'm not. Of course, when I started, I told you that I'm not going to praise one person and then say the other person don't know what they are doing, because there's nothing that even proves to me that what I'm doing is the correct thing. Okay, so I'll just put that aside. Okay, I'll put that aside. All right, so see what I'm saying here. See what I'm saying. I'm taking you somewhere. All right, I'm taking you somewhere. So just see it. Some people say that we cannot talk about liquidity unless time is involved. And I'll say that, okay, do you realize that the actual institutional guys, do you know that they are not selling, they are not necessarily selling with you every second. Some people are using the daily time frame. If I'm using daily time frame or H4, right? Do you know that the liquidity that you're spotting, you say, oh, I'm using time. When I say time now, what I mean is, some people will tell you that it's the Q zone, right? They tell you it's the Q zone. So if you're using the Q zone, only the liquidity that happens during Q zone, if that's what you're using, liquidity that happens during Q zone, what does it mean? It means that it's only relevant for day traders, all right? So if you're not a day trader, it's going to be difficult for you to even see it, because it's going to be embedded in a candle. If this is H4, that your Q zone may be embedded inside here. Or if this is daily, all your Q zones are embedded inside one daily candle. So we can't even make reference to that if we are not day traders, all right? So I'm just pointing that out. I'm not trying to say that it's wrong, because, of course, if it's wrong, it will not be out there, and then I see a lot of guys I respect who are actually making use of that concept. So there's nothing wrong with that. But I'm going to show you how you can use it regardless of, what time frame you're using. Okay, what time? You just need to see it. So I'm going to be talking about the appearance. How do you know that there's been a liquidity grab there? All right. How do you know whether it's a liquidity? How do you know where the next draw on liquidity will be? Right? Where the next draw on liquidity, where is the market going to from here now? Which one are we supposed to take? Which one are we supposed to target? Those are the questions when it comes to liquidity. We have generally agreed that, you see, liquidity is important. Why? Because without cash, there will be no movement. And it's simple. If you don't bring cash for me, if my goal is 500 naira, if you don't bring cash for me and you carry your pressing iron and say I should take pressing iron for me to get a good, there will be no transaction. So there will be no movement. That's what I mean here. There will be no movement. All right. So what is going to make movements to occur? Stop losses have to be taken. People have to be lured to open their position in a particular direction. And then there's the guys they call the dynamic traders. And for the, I know that a lot of people call them all sort of names. Okay, they call them smart money. They call them big banks. They call them big boys. You call them anything. I just like to call them dynamic traders because they are, you know me, I am very heavy with psychology. So I just see them as being dynamic, right? They are not like the retail. The opposite of the dynamic guys are the retail guys. And if you like, remove yourself as a retail trader. That one is your own business. If you are trading with $100, $1,000, you are trading profit, you are a retail trader. Forget about anything anybody is saying. Retail simply means that you don't have enough money to move the market. All right? So I know that when we come to retail, we start to group them now and say, see, in the hierarchy, if you come from CBN, you come to the prime brokers, right? Or liquidity providers. The liquidity providers, right? All right? You come to liquidity providers. You come to the big banks. Okay? You come to big banks like JP Morgan and the rest. This is the way the thing goes, right? Then you come to what's it called? You come to the retail brokers, all right? These are the XNEX, IC Markets, all these brokers, right? All those brokers. And then you have the retail trader, all right? So except you have another name that you call yourself, I don't know, but this is how transaction is made possible. These retail brokers are the ones that give you MT4 and MT5, all right? They give you MT4 and MT5. So what it means is that if you're trading on MT4 and MT5, you're a retail trader. If you have big money like the big banks, you can transact directly with the liquidity provider. You don't need to, you cannot put your order of, $10 million on MT4 and MT5. That's a lot. All right. You're even using leverage. You're using 1:100, 1:500. Some people 1:infinity. So you are a retail trader. That's what I'm trying to say. So I'm clearing that thing for you so that you understand. Okay. The retail trader can have different concepts. That's where people make the mistake. Some people trade maybe support and resistance. Some people trade ICT, SMC. Some people trade patterns. Some people trade with indicators. Whatever, right? So the only thing I will now tell you here, which is going to be my own way of mocking some people, is that you can be dumb money. All right? And dumb money does not mean support and resistance. No. Dumb money is the failure to spot liquidity. Failure to spot liquidity. If you cannot spot the liquidity on your chart, if you don't see, they have taken this person's money now. These people have actually just taken this person's money. If you cannot see it, just know that your own money will be taken. That's what I have to tell you. If you cannot say that, they've taken this person's money, now they are targeting this area. If you cannot have this relationship clearly, in whatever strategy you are using, I don't care. Just know that you are dumb money. And you are the opposite of the dynamic traders. All right, so dumb money, retail traders are mostly, even some of the big banks here, they lose. They take losses sometimes, right? This bank is transacting, this one is transacting. They are not all doing their thing together. So this one is losing, this one is losing sometimes. This is taking bank money from this one. There are big banks that will close their year without making any money. And then the ones you hear of that are big banks, they are the ones that have been doing it consistently. Goldman Sachs, JP Morgan, Bank of America, all these big banks. These are the ones that are truly profitable. Okay, but there are some that this year they make money, the next year they don't make. They are big banks, they have millions and trillions. But they lose. They end the year in losses. But overall, I want to believe that they make money. Because otherwise they will fold and then they will liquidate. Okay, so I know it's a lot of theory here. But this is if you don't understand what you're doing, you open the chart, you're going to be lost. So I'll tell you how what I mean when I say there's dumb money and then there is the dynamic money. All right, the actual guys that know what they're doing on the chart and then they are going for it. See, let me tell you something. If you in your house you have an account that has $1,000, yeah, you have $1,000. This is very possible. $1,000, right? So retail, your retail, you have $1,000. Then the smart money, or the guys we call the dynamic traders, all right? The dynamic guys, they probably have $1 trillion, right? They have $1 trillion. They have money, right? They have money. Or they have $100 million. Okay? They have $100 million. That's very easy for you to, imagine. Okay, $100 million. $1 trillion is not too much. Okay. So let's just say, okay, one person, $100,000. $100 million. Now, you will use your 1%. 1% of your $1,000 here is $10. All right? It's $10. Their 1% here, 1% here is what? Should be, let's say, $10 million. No, that's 10%. $1 million. $1 million. Okay, so now they are trying to buy. You are trying to buy with $10, and they are trying to buy with $1 million, which is 1% of their account. $1 million, 1% of their account. All right. Now, see, let me tell you something. If they try to buy, I want to buy something with $1 million and I need it. How am I going to get it? I need people to sell what $1 million. Otherwise, what they're going to probably tell this guy is, see, the best thing we can do for you is when the price gets to 10, you will feel you a little bit. When it gets to let's say when it gets to 10.5, we'll feel you maybe another maybe $10,000. When it gets to 12, we'll feel you maybe $100,000. When it gets to let's say 15, we'll feel you again another let's say the remaining maybe $200,000. Then you wait until it gets to maybe 25 before we feel you the rest, maybe the remaining 300K, for you to get filled $1 million. All right, this is what will happen if there are no if the guy is trying to buy, right? If there are no sellers, he cannot buy. If there are no sellers, he cannot buy. What does that mean? It means that he's going to need, if he has to buy at 10, maybe between 10 to 11 instead of between 10 to 25, he's going to need sellers a lot. And there are millions of, there are over 1 million, of course. There are over 1 million retail traders, okay, who are seated on their computer on the London break. All right, so Asia has done its range, right? AMD. Okay, we know the AMD pattern. AMD is that thing the market, goes like this and then distributes. So this is from here to here, you have the Asian range. All right, so this is Asia. And then this area is what? This is the M, which is the manipulation. All right, the manipulation. And then what you have here for the rest of the day is D, which is the distribution or expansion in the upside. Okay, so see what I want you to understand here. This is dumb money, and this is, see, you can be trading ICT and you'll be dumb money. You can be trading SMC and you'll be dumb money. So you are all retail traders. That's what I'm saying. So what you need to understand is, are you dumb money, or are you trying? Because I'm not trying to say I don't take losses, right? But I'm trying my best to look at what the market is doing on the left side of the chart to see if there are people who, if I'm not seeing people who are trapped, right? People who have been stopped, or people who have been lured to sell when the market actually wants to buy, I'm probably not going to buy. The best trades are the most difficult one. That time the market is steaming and coming in your direction. As long as people have been liquidated, you can see them that they have been liquidated. You're probably having a good chance of getting filled and then the market moving all the way to target. All right, so that's exactly what I'm showing you now. So see what happens on the Asian range. We have that range, right? So what is happening? The market is just ranging, right? And then what happens? This guy needs to sell. He wants to sell 1% of his portfolio, right? Which is $1 million. What will he do? He needs to bring out, let's say, 200,000 first from this money. And this is just all numbers in the air, okay? I know that it's a lot more than what I'm saying. he probably might have $1 trillion, and then 1% of his money is $10 million, and he's trying to use that to trade. Okay, so it can be bigger, it can be smaller, I don't know. Most of us don't know. So just relax. Okay, so what we're saying is very simple. What do you see here? We know. In fact, sometimes you see the market will come and do a week here. All right, this is FTC. Fail to close. Okay, I'm going to teach you three appearances. You see fail to close, you see trap, which is climax. All right, it's climax. I don't have textbook for my teaching. My own teaching is as it's coming, I'm giving you. Just position yourself well to collect and write notes. As you are learning, be writing your notes. All right. So just keep taking it in. No matter how fast I am, just try to take it in. If you have to come back to the. Hopefully, I will allow the video to stay. Okay, so you come back to it. So see what happens now. They say, oh yeah, the market is going to buy. What do these guys do? What are they doing here? What are they doing? It's very simple. Their intention is to sell. They want to sell. They want to sell. But for them to be able to sell, they need to make the dumb money. They need to make the dumb money, guys, not retail traders. Some retail traders know what they are doing. Some retail traders don't know what they are doing. Some people are trading support and resistance. They know what they are doing, and they are making money. And some people are trading. Fibonacci. They know what they are doing. I'm making money. Some people are trading it. They are still losing money. So see, dumb money is once they start to see the break. What are they seeing here? This level has been cleared. All right, the level has been cleared, and then what has happened again? There is what? There is that's what they've made you. They've lured you to open what? Buy. Now imagine 1 million of us, 1 million of the retail traders sitting in their house, just like myself, right? Sitting in their house, just like myself, and they're opening their chart, and then they are seeing what? These big green candles, and then going this direction. What do you think they're going to do? They're going to try to buy. They're going to try to buy. And then this is just all what? Manipulation. What are these guys trying to do? They are using some of their money to buy the market up, right? So that what will happen? All the people who think maybe they do the analysis, they say, oh, today is a sell or something like that. Something tells them we're selling, we're in a downtrend and all that. When they start to see the buys like this, what do you think they're going to do? They're going to feel like, oh, in fact, they are already selling. Some people are already selling, right? Even before London session, some people have already started selling with their stop losses up here, right? So what do you think is going to happen? They will be stopped, all right? Now, when the market stops them, what do you think has happened? The market has made money available for what? For the sell side. So they've been stopped. Now, these guys will now do what? When they see that, okay, well, most people have now started introducing their $10, $1,000, small money, all that money, when you put it together, it will now give them that money that they want to sell. So what do you think they're going to do? Now they will now place that order. Once they place that order to sell, what do you think Mark's going to do? He's going to distribute and then go down. All right. And then what do you see? These guys are the range. These guys are the people who have been manipulated. And then this is the actual direction of the market. Okay. This is one example out of so many. All right, this is one example. I can go on and tell you, oh, this is how the institution are trading. Everybody have their own. That's why I say, don't come and tell me, oh, you did not get it. This is not how it is. It's my own. Leave it for me. It's making me money. I don't need your suggestion. All right. So what I understand is they have to lure people to buy so that they can get enough money to go in before they go to the direction they want to go to. That's very important for you to know. All right. So if your stop is in the way, right? Some people say, oh, this is double bottom. Let's double bottom. Let's trade it. All right. Or they see the first one and then they say, oh, potential double bottom. Let's buy other block or whatever, right? And then the market, what does the market? The market will go like this and then it will come back and sweep them away. So what do you see? What do you see? You see this happening over and over. All right. I know that when we talk about liquidity, the only thing that comes to your mind is trend line liquidity and double bottom. That's not liquidity. There are many things that is liquidity. But this is just part of it. So the only thing I just want you to see is, the main thing I want you to see, the main thing I really, really want you to see here today has somebody been stopped? Has somebody been stopped? Has somebody been liquidated? I just explained something to you now. I said that if they want to enter, before they will enter, let's say you analyze and you say, oh, yeah, the market is going to buy, right? You think that the market is going to buy. Oh, there's a sweep. This is a low. Break of structure. Break of structure. I'm expecting what? Pullback for me to buy. What has happened here? What has happened here? Some people want to buy here. They've been stopped. They've been stopped. They've been stopped. If they've not been stopped, this one no go work. It won't work. There has to be liquidity to take and liquidity to what? To target. Where is the liquidity to target? The one that is here. There must be liquidity build up so that the market will clear it. And this liquidity has to be a low resistance liquidity. When I say low resistance, if the market is going like this, it's taking this one and coming to make new low. It goes again. It takes this one, come to make new low. This is high resistance. So this one is high resistance. Before the market will come back and sweep this one to take, because the money has been taken. There's no money for it to take again. The money has been taken. Are you hearing what I'm saying now? Once this happens, this now becomes low resistance. Why? Because there's no money. The only money here is just the one here. It has taken money here. So the chances of the market coming to sweep this one is low. What if it's just going like this? It's going like this. This is high. This one is what? Low resistance, right? This is low resistance. There's been no, you're not seeing, look at it very well. You will not see any, just look here. You're not seeing that people have been trapped or people. Okay, let me show you what I mean when I say appearance. There are three appearances, right? What you see is, you see something like a climax. Oh, my apologies. Sorry about that. My apologies. I don't know if it's possible it could be from your end, because I think everything is good and green. So it could be from your end. Someone is complaining that it's breaking up. So just check your network as well. Okay. So I'm getting to the cream de la cream, all right? The lotus okum. Okay, so just stay with me. I don't know if that's a word, so that you don't go and start researching it. All right, so it can be a climax. A climax is a trap, and that's the one I just explained to you, right? What do you see is the market pushes, and then what do you know is it falls. See, this is a trap. It can be a measured move. The height of the range and the height of the trap. If this is 10 pips, this one will be 10 pips. Go and look at it. Go and look at your market. Just go open your chart and look at it. Right? This is a trap. It's called the FFF, the faded final flag. It's called the faded final flag. Right? It's a faded final flag. When the market has been going up, the market now gives you the range and then it extends. Where is it going to? It's been going up. See, the market needs to introduce sellers. If it does not introduce sellers, it will not buy. The market needs to introduce buyers. If it does not introduce buyers, it will not sell. Take that home. Look at the chart. And if you have not seen that the market has introduced the opposite people, just know that your buy will not work. If the market has not introduced the opposite, your buy will not work. And that's why I see a lot of people use limit orders these days, right? Especially the smart money guys, because they try to be smart. All right, but you need to learn everything and understand what you're doing. Okay, so yeah, if someone is in a limit order, he's just simply trying to say, I want you to buy when you are selling, right? When a lot of people think you are selling, that's when I'm putting a limit order to buy, right? Because a lot of people even use it, they don't know why they are using it, right? The psychology there is that the market has been selling. I'm seeing the market. See, when my alert goes, if I'm waiting for the market to get to a particular level, right? Maybe I'm interested in buying from a particular level, and I get my alert. All right, apologies for that. Okay, so if I get my alert, what do you think I'm coming to look for? I'm going to look at what has been happening here to see if some of the people have been liquidated. I want to see maybe support and resistance, right? I want to see somebody. What are the types of all the types of liquidity that you can have? See, you can have a previous swing high or a previous swing low. All right, something like this. All of them are liquidity. All of them liquidity. Money is there. All, because they eventually become what? Double top, double bottom, and all that, right? So all the swing highs, swing lows are liquidity. Which one should you use? You will find out now, because I'm going to tell you draw on liquidity. What is the cycle of liquidity? Where is the liquidity going to? All right, you're going to understand that. Okay, so previous high, previous low, equal highs, right? If you have equal high, equal low, right? Relatively equal highs, equal lows, right? Something like this, something like this. Okay, that we don't want to see the right one exceed the left one. All right, because if the right one exceeds, it means that is now a high resistance. Why? Because the money has already been taken. So the chances of the market coming back here is low. Even if it's coming back, this may probably be protected. All right, why? Because it has been it has swept. All right. So that's equal high, equal low. We've got equal high, equal low. We have of course the one that most people know, which is the trend line. Okay, have the trend line. We have the trend channel line as well. Okay, trend channel line is the one under. So what's the market doing is taking the transactional liquidity. Okay, it's taking transactional liquidity, and then it's going back, it's coming, and then there's liquidity here. All right, and I like to see this one as a low resistance liquidity. Okay, of course, even if it's a high resistance liquidity, once the market has built up too much liquidity here, whether low or high, especially if you know the tree drive pattern, right? The tree drive pattern. After 3 pushes, 1, 2, 3, what will happen is to clear it. Okay, so whether it's low resistance or high resistance, eventually it will be cleared. All right, but we prefer to see that there's less money to be taken on this side and there is more money to be taken on the other side. So that's where we expect the market to go to. So I will show you that in a moment. All right, so there's a lot. Fib levels are all liquidity areas. Okay, which one are you going to use? Is it 31? Are you using 38? Or are you using 62? Or are you using what? 75? Which one are you using? Liquidate this one and go here. Are you using 50? We'll liquidate 50, go to 62. 61.8, right? If you say 61, but it will liquidate 61.8 and go to 75. All right. So you see, so people are going to get liquidated. And that's why you see some guys will tell you premium on discount. Why? Because they want to see a lot of people liquidated before it gets to the discount area. Okay. So there's liquidity to be talked about when you talk about the fib levels. Even the so-called order blocks and order flows, they are all liquidity areas. You see, a clean order block that's supposed to hold, it does not hold. Why? You see, it doesn't hold. Why? It's used as what? Liquidity, because there's too much money there. Too much money. And I tell you this, when an order block is mitigated, it becomes a high liquidity level. Meaning its resistance to liquidity is low. Once an order block is mitigated, in fact, that's what you call double top now. Double top, this if you have order block here, market comes back, the chances of market clearing this area is very high. So a mitigated order block is now a draw on liquidity. That's what I'm saying. Once the order block is mitigated, the next time market comes to that area, it will just absorb it. And that's the third type of appearance, absorption. Some people call it displacement. It's the same thing. All right? It absorbs it. It just goes away. You go as if it is not existing. It's absorption. Okay. Okay, my apologies. I think if you're not receiving it correctly, then I cannot go on with the class. So maybe we have to reschedule. Okay. So maybe I will just wrap up. I'll wrap up and then we have a part 2. All right, we have a part 2. Okay, because everyone is saying that it's breaking up. There's no use talking if you're not receiving it clearly. So we've actually talked about a lot here today. No, this is for my students. Where did we start from? Somewhere here. Yeah, okay, here. So you can see we've actually covered a lot. All right. So I walked you through, cash, money. That is liquidity. Money needs to be there. If money is not there, then there's no liquidity. All right. So liquidity is money. Some things are liquid, some things are not. If money is not there, market will not move. So why I took my time to explain that to you is so that you will understand something which is very important, that if you don't see people on your chart, if you don't open your chart, maybe we have this call again next week so that I can open the chart and show you some things. Okay, see, if you don't open your chart and see people that their money have been taken before your entry order, your own will be taken. If you open your market and you cannot say, oh, this person's money has been taken, this person's money has been taken, this person is trying to sell support and resistance here, but the market has stopped him out. If you don't see it, just know that your own is going to be taken. Guaranteed. All right, going to be taken, guaranteed. I bet you. I have to also even stop because I have to watch Chelsea. So it's inevitable for us to reschedule the class. There's a lot that I still haven't taught you. In fact, I'm going to make sure that most of the guys, I'll post this so that most of the guys can watch it as an introduction to liquidity. All right, so that you understand it first. First, get the knowledge, understand it, so that when you go to chat, you know what is happening. It's not a draw pattern. I can make it 10 minutes. What I'll do, I'll just draw the liquidity thing for you, the one that you will know. That one you know very well. The liquidity one, triple bottom, is it not? And one. See, what I'm showing you here is what is happening inside the chart that you can use to make real money. That's what I'm showing you. What's happening inside that you will use like this, you make money. This is not, you don't need to go and come back. You will use it and make money direct. See, I don't know why this thing is breaking. So see, there's still a lot. I've not even mentioned the time, right? I'm still going to talk about time because there's some guys who say that the liquidity has to happen in a particular time. If you know, my name is Day Trader Benny, so I trade daily, right? Every day I'm trading, right? So we need to look at the time. How is time a factor in liquidity, right? Some people look at time and then they say the previous day's high, previous day's low, previous week's high, previous week's low, previous sessions high, previous sessions low, right? Previous sessions low. I'm going to stop the class soon, okay? Previous sessions low. So what is happening here is time based, the day. So in fact, when you see, I tell you the daily high, the daily low, right? The daily high, the daily low, and the daily close. The daily close. Where did the market close? You need to check that line. It's a draw on liquidity as well. It's a draw on liquidity. All right, daily high, daily low, daily close. Draw on liquidity. And you can use it as a reference throughout the day. Session high, session low, session close. Session high, session low. Asian high, that's what I mean, Asian low. Draw on liquidity. All right, or liquidity areas. Then some people now come and break down this area to 90 minutes. They say every 90 minutes, the high and low of that area, every 90 minutes. Hey, nothing I never see. Every 90 minutes, you should check. You will see liquidity from New York Open. Every 90 minutes, the high and low, every 90 minutes is a draw on liquidity. If market sweeps it, expect sell. If market sweeps it. So see what I'm going to do. I will close. I will close. Then I will show you. I'll also show you appearance. Remember, I told you 3 appearances. You will see fail to close. Fail to close, what you see is just the wick. The wick is showing you the momentum, hurriedness. We just want to collect that order. It's big enough to trigger a stop loss at the previous high. Where do you keep your stop loss? If I ask you, as a trader, where do you keep all your stop losses? Where? Previous high and previous low. Anything you are doing, is it not? It's previous high and previous low. Under other block or under breaker block or under anything, right? So your stop loss is somewhere at previous high or previous low. So all previous high and previous low, they are liquidity areas. That's where cash is. You understand? That's where cash is. So I'm going to teach you. See, I will teach you this thing. You will understand it, and it will make a lot of. It will add you. It will add. I'm very sure it will add something to your arsenal. All right, it's going to add something to you. Okay, and you will never see the market the same way after this class. So unfortunately, I have to close here for part 1. So I'm going to have part 2. All right, part 2. I'm not going to do a lot of theory anymore. Part 2, I'm going to go into the chart so that I can start showing you. All right, so there's not so much for me to talk about anymore in terms of theory, okay, because you now get it. Cash is required, right? You get it. You need to see that people have been lured to buy. If the market wants to sell, people need to be lured to buy. So, and then you need to also understand, I said weak. The weeks, the way the market weaks, that's 1. Number 2, trap is called climax, FFF. That one is liquidity as well. You need to see that the market has overextended after some consolidation, or somebody who is trying to say, oh, there's a break of structure, the market is pushing high, the person tries to buy, market pushes, and then the market reverses and never ever revisits that area. Some people have been trapped. Then there's the one where there's a double bottom, you try to buy it. There are some people that stay at once and blow their account. Do you know what the type of liquidity there is called? Absorption. They have been absorbed. So the market will clean them and continue. It absorbs them. And then when the ICT guy comes and look at it, he'll say, oh, there's a displacement. Right? The market has absorbed people. And if you are the type of person that say, oh, I don't use stop losses, if you get absorbed, you blow your account. You can trade 20 times without getting absorbed, without a stop loss, right? But if you don't have a big pocket to hold an absorption, in fact, you get margin call. It's difficult, except your lot size is micro. If you're using normal, maybe standard or whatever, right, you'll be absorbed. All right, so I'll stop here. So, me, normally when I start to teach or talk like this, I know it's to close. So, but I will just stop here now so that I give those that are not hearing very well, I give them the opportunity to hear again. I don't know why the network is bad today. I don't know if it's from my side, because really I looked at it and it was all green, right? It says that this connection is good. Ooh, okay, yellow, yeah, green, orange. All right, that's fine. So I'll close the class. So I just want to tell you, right, you can see that you're getting good stuff from this. Check out some of the other videos, the live ones that I have. Okay, there are some other live videos that I have on this particular channel. I'm telling myself that next year I'm going to push out a lot of content, okay, so that I can reach out to more people, right? Because I think that's the way the thing works. I need to carefully, you can see how I teach is, here. Right? So I'm going to be making clean videos where I go step by step, and then I organize everything beforehand, and then maybe use slides, and then I'm teaching you everything one by one. All right? So I'll make those videos on all the topics. So if you're trading, you see what I'm teaching you here today. Liquidity, structure. You understand structure, you understand liquidity, you understand your supply and demand. Bam, you are done. I think SMC is very, very profitable if you know what to do. If you know what you are doing. Hey. SMC, structure, liquidity. No, leave it to. It's profitable. It's very, very profitable. I'm telling you 100%. It's very profitable. The only time when you come to SMC and you say you don't know anything yet, you have not learned, you just pick one pattern. You say, oh, this is pattern, I'm looking for pattern. And you're looking for pattern up and down. You have not learned, you don't know what is happening. That's why you're not making money. But it's very profitable, I'm telling you. It's very profitable. Even if you will have losing streaks. We all take it. We take it. So the losing streaks will come. But guy, for the most of it, you're making money, right? If you know what you're doing. So just stay with me. Stay subscribed. Share the videos. Share them so that your guys will see, and then they will be liberated. Okay? So I will stop here. Thank you so much for the time. It's always a pleasure to be with you on this call. Do have a lovely week ahead. And my connection is excellent. I don't know why people say it's breaking up. Oh, it's breaking up. All right, good. All right, so no problems. Till next week, I will post the link for the next one in the Telegram channel. So I'll see you guys there. Thank you so much for your time. Until next week, cheers. Okay, good evening, good morning, good afternoon, everyone. So I'm going to try my best to keep this video very short because it's a part 2, and I'm planning to put it together. So I think before I say anything, I have to welcome you to a brand new year. Okay, so I believe this is the first video I'm making on the channel in the new year. So this year is a year where I really hope that we can capitalize on most of the things that we have been learning over the years to put some money in our pocket, right? So it's one thing to learn and learn and learn. It's another thing to put that thing to practice and then use it to make money. So I'm hoping that this year is going to change some things for us. Okay. I'm not going to waste time today because I think most of the thing I have to do for you today is to go into the chat, show you a couple of things so that okay, just wanted to be sure that the reception is clear. If at any point the reception is not clear, please let me know. Okay, because I'm not going to be listening to the volume, but I will be seeing your messages. Okay. So this is going to really improve the game for you if you are an SMC trader. Okay. I clearly do not have enough room here. So I'll work with this. Okay. Okay, so just if at any point you're not hearing, please let me know so that I'm not talking to myself. Okay. Just maybe go to my Telegram, my WhatsApp, or wherever. Just send me a text, basically, so that I know that there is a breach in connection. Okay, so the last time I talked about a lot of things. I tried to explain. You know how I always explain. I like to go like even if you're in primary 1, you will understand what I'm saying because I always try to make it. I break it down to the simplest form, and I taught you what liquidity is. I taught you what is liquid and what is illiquid, right? If something is liquid, it can be transferred easily. It can flow. It is fluid, right? It's fluid, meaning it can flow easily. That's what it means to say something is liquid. If something is not liquid, it means that you cannot transfer it easily. You cannot use your shoe to go and buy food because your shoe, even though it may be worth a certain amount, it is illiquid, right? It is illiquid. What is liquid is cash. if I'm traveling to a country now, I have to, I have to liquidate. Like, I have to ensure that I have their currency, I have their cash, so that I can make purchases, so that I can buy things from them, or do transactions, right? The last time I think I made an example, I said if I want to buy a good, I cannot go and say, oh, I have I have hen, or I have a car, or I have a bicycle. Please, I want to buy your goods with my bicycle. Bicycle is not liquid. So whenever you hear the word liquidity, what we are saying is ease of transaction, ease of exchange, ease of exchange. We need it. It's the fuel that the market uses to move, right? How does the market go from point A to point B? Somebody has to be liquidated. If the market wants to sell and the people that are buying have not been liquidated, it won't sell. If it wants to sell, if it wants to buy, the people who are selling, if they have not been liquidated, it will not buy. All right. So there are two things the market will usually do. The market will and see, let me tell you this. Those of you who think that maybe there is no manipulation in the market, there is manipulation. I have to tell you, right? Some of you say, oh, the market will do what the market will do. And see, your normal natural emotions can lead you to take, losses, right? Can lead you to take losses. You can have emotional, problems and take losses. But the manipulation in the market can lead you to blow your account. The manipulation in the market will not, emotion can make you misbehave. Manipulation will make you blow your account. Let me show you. I believe you can see my screen. Let me just show you an example of what I'm saying real quick. Let me go to an intraday time frame. Let's do something like maybe 5 minutes. I'll show you this example. Now, let us assume that you woke up in the morning, right? You woke up in the morning. This is the session break, somewhere around here, right? That's where we have the session break. Okay, so you woke up in the morning, Asia kicks off, market pushes, comes back a little bit, pushes again. Now, this is the area where London opened, all right? This is the area where London opened, somewhere around here. That's where the London session started. Now, if you're going to trade this market, okay, looking at what has been happening, you're most likely going to say, oh, maybe we now have an uptrend. Is it not? You say, oh, we have an uptrend. Maybe the market is going to buy. And then what are you looking for? You wake up and then you buy. You buy here. Is it not? You buy. All these bars, you buy them. Look at them. They look like they're going to break out. Right? You buy. When you buy, what does the market do? The market is going to sell. Take the stop loss. Right? It's going to take the stop loss. Okay? So even if maybe you bought earlier, right? You bought earlier, maybe somewhere around, it will take your stop loss. Right? It will push down and take your stop loss. Now, if you now say, okay, I can now see that the market is selling, right? Market is selling. Initially, you thought that, oh, because of what is happening here, you say, oh, he's going to buy. You try to buy. You get an SL on your first buy. Now, it starts to sell aggressively like this. Then what do? You say you want to do what you want to sell. Maybe you sell somewhere around here, right? You sell. By the time you sell, what does it do? It starts to buy, right? It starts to buy. See, what I just want you to understand with what I'm showing you, I'll show you. I'll show you some more, right? See, if you're sitting down, right? If you're sitting down, you're going to wake up in the morning and sit down and look at how this candle is moving to make decision to buy or sell. You will blow your account. I can promise you. If you don't have the habit of waiting for something that you expect to happen before you engage, you blow your account. Because the market is going to tempt you. See, if the market wants to, the way the market moves, if the market wants to buy, it will first convince you somehow that it wants to sell. It will make you feel like, oh, I'm going to sell. And then what do? You start to sell. You put your stop loss all over this place. And then it will stop you out. That's what it does every time. And if you say, oh, okay, I was wrong with that one. Maybe it's not a buy, it's a sell. After you have been stopped, right? You try to buy here, it stops you. What do you do again? You say, okay, I'm going to sell. And then it will stop you again. right? Because even if you're selling maybe somewhere in the middle here, because of course you're impulsive at this point, right? You sell here, your stop loss is maybe in no man's land. Now the market starts to go against you. Look at how strong this bar is. At a point, it would have been so big, so full, so green that you think that the buy that was your original idea has resumed. And then what will you do? You either would have, canceled the trade, or you would have been stopped. And then what happens? You now say, okay, he's now buying. He's buying maybe from this level, whatever. You can, bring up a level here and say, okay, he's buying from this level. What happens? It will stop you. Now, what do? It stops you again. You now say, okay, originally, this buy is struggling. Maybe he's going to sell. And then you sell again. What does he do? That sell is still going on. And then see, look at how he's pushing back. He's pushing back. It's going to scare you out, right? You're going to there's something called shaking off the weak bears and shaking off the weak bulls. This is the market always shaking off those people who want to sell. See, look at this market. The entire day is sold, right? It's sold. The entire day from here to here is sold. But in selling from here to here, it will shake off the weak bears in this case, right? It won't just go from here straight down. No, it will keep making people feel like buying is a good idea. And the market will do it over and over. There's only a 10% chance or 10% space where the market will not do that. But most of the time, that's what it will repeatedly do, right? So that 10% gap when, okay, you say, the market is going to sell, and somehow you cut it and the sale starts, it's going to happen only once. Before this one will even happen for you, somehow you would have lost a lot of money here, and you're trying to over leverage here to cover up, which you will do sometimes, and then it will give you the courage to come back and repeat the same thing again. And then what you do is you eventually lose your money the next day because you will not be able to cope. There is no edge in what you're doing. You're trying to look at the market as it's moving and buying and selling. You will lose all your money. Some people call it scalping. They don't know that in scalping, you are waiting for a setup. You're looking at, is there a fair value gap or an order block, or maybe a breaker block, or a block formation, or the market is pulling back to an important level and I want to sell. That is what scalpers do. Scalpers doesn't mean that you are buying every minute, every second. That's not what it means. You are trading setups on the lower time frame. That's what it means to scalp. Scalping does not mean open the chart, open 5 minutes, open whatever minutes, and start buying and selling as the market is moving. You will throw away all your money, because all the market is designed to do is to create confusion, is to lure you to do the opposite. If the market wants to sell, it must first it will induce, it will make sellers. If it wants to buy, it must make sellers feel that it wants to sell. If the market this is 100%, I can bet you on this. Anytime the market wants to sell, it will make the buyers feel like it's going to buy. Look at what I'm saying. The market sold, is it not? It's sold. Look at it, sold from here. What is all this? What is all this? What is all this? Is it not making? If you look at this, do you know where it's coming from? It's coming from somewhere around the open, around the Asian low. Is this not? This is the open, the Asian low area. Some people say, Asian has been swept, and then they try to think that the uptrend is continuing from here. And what happens? They buy. Look at all the big bars. They buy here. They buy from here, Asian sweep, something like that. And then they buy, and then what happens? The market doesn't go. It consolidates, it stops them out. All right? So it wants to sell, but it will induce you somehow to buy. That's why the best thing for you to do, understand liquidity, understand, why will I not be interested in this? There are reasons why I will not be interested in it. There are lots of reasons, right? There are lots of reasons why I will not be interested in it. And that's what I'm going to teach you today. When you think that a move is important, it is not just by looking at the move. You must look to the left and understand two important things. Has liquidity been raided? If yes, what is the time of liquidity? That is what breeds, or that's what brings about intentionality. And then this is exactly what I did. If you look at the very recent post that I put there on the Telegram, it's the same. This is the same day. I don't know why he's texting me. Um, say I should help him with what the session high. I don't know what that is. Okay, so this you can see this trade, right? It's the same day. What did I do here? What I did here is simple. We wait for liquidity to be taken. There was liquidity to be taken to the left. Immediately liquidity to be taken gets taken. We combine that with the right time. What is the time? This is the opening of the London area. Liquidity has been taken. This is the time now for London to push all the way down to the downside. Exactly what I did, right? And it's the same thing I do. I can show you, some of the other posts that I have made on the channel. It's the same thing I do every time, right? Why am I buying with the limit order here, right? Liquidity is taken. The liquidity here is taken. I hope that you can see. Look at this. There's a trend line liquidity here. I already introduced this topic in the last class, right? There's a trend line liquidity here, and there is a trend line liquidity here. So it's easy for me to, put this limit order here with a stop loss here. Already, this is not just a random trade. This is from an important area. So once the liquidity is taken and there's liquidity to be targeted, it's easy. It's easy. Right? The market will sweep the liquidity here and target the liquidity to the upside. So I'm going to take you through some things here, and this is what I'm talking about. And you can see that's the trade. Look at all of this here is liquidity, right? Once the market takes that liquidity, it's going to take the one on the opposite side. That's all it does every day, right? And so what is remaining is, do you have the courage now, after you get in, put your stop loss, do you have the courage to sit through and allow the cake to bake? That's the question. Because when all these things are happening, it can take you out. It's not every time you take a trade that the market goes straight down, right? This is from morning till somewhere in the afternoon, I think prior to London Open. To New York Open. All right? So it is all liquidity. And I already explained liquidity, the introductory part in the first video, which I think after now I will combine the two videos so that you can watch it in one stretch, right? Those of you who have not seen that video, but that video is very important for you to have some fundamental knowledge as to some terminologies, as to the entire concept around what liquidity is, all right? So that you combine it with this, right? We were having a lot of glitch the other day. That's why I did not finish up that day. I decided to extend it to today, and we have been postponing. So I'm happy that we're finally here. All right, so I'll just share a couple of things that's going to teach you. This is, I believe this is some of the things that we have done in the past. No, this is part of the mentorship. Yeah, this is the liquidity area, right? So you can see we did a lot in the previous video. We did a lot, right? We did a lot. So you might want to go. So you can see how I have explained, what liquidity is. I talked about all the, some types of liquidity, how money flows from CBN down, what dumb money actually is. Some of all these things, Asia session, manipulation, and then distribution. I taught all these things, right? Failure to close, which is some of the things that will be important for some of the things I'll be showing you again today. And then some basic types of liquidity, trendline liquidity, previous high, previous low, session times. Yeah, don't worry about that. I'll send that to you. Right, previous high, previous low. I talked about faded final flag, right? You just go back to that video. You are going to love that video. I think I also talked about time as an important factor. We're looking at the previous day high. If the previous day's high is swept or the previous day's low is swept, it's a chance for liquidity, right? If I sweep everybody's order the previous day and I displace, right? I show impulsiveness to the opposite side. Then, it's safe to say that there's a liquidity sweep if we combine that with the time when that move is happening, right? The time when the move is happening is equally important because, I'm going to talk about this later on, right? When I finish some of the things I want to show you, so that it will all make sense. This wasn't part of. I think this was the session I had with my guys. So I'll just continue from there. Let me see if this is big enough. Okay. Yeah, so that's okay. So see what I want you to understand, or what I've tried to make you understand is so far is don't chase, right? Do not chase. Do not chase, right? And this is very important. Whatever you do, do not chase. Don't chase. Don't wake up and then you're looking at, you will be used as liquidity back to back, because the market will deceive you 100 times, right? If you try to buy, the market will sell. If you try to sell, the market will buy. If you try to buy, the market will sell. Why? It is dragging you to buy. Only 20 to 10% time when it will allow you to see that it wants to buy and actually buy. But that is a bad mass. It's a very bad mass. You will blow your account, you will lose your money. Don't do that. That's what I'm saying. Now, how does the market go from from point A to point B, right? If a market is going to move from point A all the way to point B, how does it do that, right? How does it do that? It needs fuel, right? It needs fuel, and this is what we call liquidity. It needs fuel. If it doesn't have it, it will not move. Okay? It needs fuel to move. Understand this. It's very important. See, I said it in the last class. I said that if you look to the left and you are not seeing who has been stopped, you are going to be stopped. There is no juju. You will be stopped. If you cannot see that, okay, let's say you open the chart and the market is steaming up, is pumping up, right? How will you know if this move is important? How will you know if this move that the market is rushing to make, how will you know if it is important? You have to look to the left, right? You have to look to the left. You have to look to the left. You must look to the left and see, has somebody been stopped? Has somebody been stopped? If nobody has been stopped, this move is shakara, is not important. See, intentionality and purpose is very important when you're trying to interpret the chart, especially when you try to call yourself a smart money trader. You must understand how to read and interpret and follow the footprints and follow it correctly. If the institutions are going to move price, they will not move price stupidly. They must take something, even if it's at least a basic liquidity, at least a basic liquidity. Trend line or previous low, double bottom or whatever. Previous day high, previous day low, something. Session high, session low. Something must be swept. Somebody must have been stopped. If nobody has been stopped and that thing is racing, and you think that market is going to pull back and allow you to go safely, it will not. I can guarantee you it will not, right? Will it do it sometimes? Yes, there's a 10% time when the market will allow you to have your way. But there is no edge in it. That's what we're saying. There's no edge in it. There's no advantage in it. That's what edge is. There's no advantage. You can do it and get away with it once in a while. But the mass is bad. It won't give you money at the end of the day. What we are learning and killing ourselves for is so that we can get something that happens repeatedly and that we can make money from. This is what is important for us. Something that happens often enough for us to be able to take money. Even when it fails, it only fails, few times, right? Few times. That's what we're saying. So you need to understand what I'm saying here. Very important. It's very, very important. When you see a move that catches your attention, don't just jump into that move. Look at that move. Is that move important? And how do you enter that move? Are you going to just jump in like a madman? No, you wait, right? You wait. Instead of jumping in like that, what do? You cool down and wait for return to impulse. Look for inducement there. Look for liquidity. Before your entry, look at where you put your entry. Look. Where your entry is there somebody's SL that is there? Now that your entry is here and somebody's SL is there, it's not even a full proof that you will be successful in your own trade, but it gives you an upper hand. Because remember what I said, the market needs buyers for it to move. Is it not? For this market to move up, right? Understand this thing now. If a market wants to move up, two things are very important. I think that was the first thing I was going to say. Two things are very important. See, SLs will be taken in the opposite side, and the market would have lured them to take that side as well. These are two things that you must see. If I want to buy a market, see, the market needs to take somebody's SL, and it needs to convince people that it is a sell. What are they seeing here? They're seeing higher, low, higher, high, whatever it is on that particular time frame. Somebody has been stopped here. There's an SL here. Somebody has been stopped. Now people are seeing this market is steaming down, thinking that, trend is down or whatever is happening, right? Somebody has had an SL. I have a better chance of taking a trade here and succeeding. Why? Because enough sellers have been introduced. My hope now is to absorb all of them. That is what I hope for. So if the market is not showing, see what is happening here as this thing is going, like this, right? As it's going like this, right? Some people think that, it's an uptrend already, right? Some people say, it's an uptrend. Some people buy here, some people buy here, some people buy here, different places, right? Put their stop loss here. Is it not? Now, what does the market do? After they have all been, after they are convinced at this point that the market is buying, what does the market do? It will now start pulling back. Is it not? It will pull back. Now, what has happened? These people has been stopped. What is the market now doing here? People are looking at the market at this point now. What are they seeing? They are saying, yes, it's now what? It's now selling. That's why I said two things. It's going to take stop loss, and it's going to lure people to take the opposite direction. Those are the two things that are going to happen before the market starts to buy. Are you hearing me now? So that's why we introduced that concept of inducement. It's not a stupid concept. It's very important, right? If you're going to be interpreting candle patterns, technical, patterns, you have to be able to read, all this information. So this is what we are saying. Now, is it a must that anytime the market comes and takes the first stop loss, it will reverse? No. If the number of people that it has induced to sell are not enough, it will continue again to go lower until it finds enough buyers before it will trigger that buy. That's why sometimes you may be right about the direction, but you still get stopped. Why? Because the market still needs more money. It still needs more money for it to transact to the upside. You will understand what I mean by it needs more money when you look at the first video, right? It needs more money. Okay, so it will keep reaching for more money. When it has gathered enough money in that opposite side, then what will happen? The move will start. You see it. So that's why you see how difficult smart money is, right? You see how this is the reality of smart money, and that's why it's quite difficult. The beauty is that if you're right, you have a very high precision, right? That's the advantage of smart money. It's precision. That's all, right? The essence of smart money is to catch a pullback, right? You're trying to catch a pullback. That's it. And you're trying to catch your pullback with precision. That's what you're doing. Some people have gotten lost in the concept of smart money. Now they are obsessed about the how the other block will look, how this inducement will be, this is rubbish. What you need to understand is, what am I teaching you here? Is there an SL to be taken? If yes, has it lured enough people to sell? If yes, then you have a likely chance of entering from that point and succeeding with that trade. Okay, so let me move forward. Right, I'm going to teach you some types of liquidity, which I think is going to be helpful, for you to understand some of the things that we're saying. Okay, so I'm going to show you there are different types of liquidity. All right. In fact, I know I've already mentioned all the things that can be liquidity: previous day high, previous day low, previous week high, previous week low, depending on whether you're a swing or day trader, previous whatever session high, previous session low, there is trend line liquidity, there is double top, double bottom, all these basic ones that are all over Twitter. You see all those liquidity everywhere, right? So it's not news of what a liquidity is. A previous high, in fact, almost every high and every top, every bottom, every high, everything, anything that is a swing like this, there's money resting under and above. That's the assumption, because you and me, if we want to enter a trade, where do we put our stop loss? We put it below the next swing high or swing low. Okay, nobody puts their stop loss in the middle like this. It can happen, but it's not common, right? It's not common. Most people always push to the swing level and then give maybe 1 or 2 pips and put their stop loss, right? So that makes every high and every low an important area for liquidity to be taken. All right, and I talked about low resistant and high resistant liquidity, and I remember I said that when the liquidity has been taken, this is now high resistant. All right, if no liquidity is taken, this is low resistant, meaning it's easy for it to get swept, right? So on my engagement areas, I like to see low resistant liquidity because I know that it's going to get swept easily, right? High resistant liquidity. They usually so I just want to be sure that everything is good. Okay, so the high resistant, it was rotating and rotating. The high resistant liquidity, you can see that if money has been taken, right? Money was taken here. Okay, so there's no much money to be taken in this one again. So you can see this high resistance, right? Money has been taken here as well. Right, another one again. Money has been taken here by this guy. See, this one has been taken by this guy, right? You see, they have been taken. So what happens is that, this is not easy for the market to sweep. That's why we say that when we want to see a valid swing level, we want it to at least sweep one high, so that we know that it's now strong, it's high resistance. All right. Now, it doesn't mean that it will not eventually sweep. It will eventually sweep, right? After the 3 drives, it will sweep. Okay, so I said all these things in the previous video, so I'm not going to repeat it, but I'm just touching so that I can, bring I can awaken your mind back to some of the things that I mentioned. Now, going forward, what are the types of liquidity now for the guys who are doing the advanced stuff, right? For the smart guys, the real smart guys, right? There are 3 types that I will talk about. Okay, and I talk about the transactional liquidity. Transactional liquidity is the one that is the one that is called so this is the liquidity that is found at the break of structure. I know you know what break of structure is, right? It's called it's called a correctional liquidity, right? It's the liquidity that corrects. Let's say the market is moving up, right? There's money to be taken here, is it not? So if the market goes up and then takes that money, what happens? It has taken transactional liquidity. So after transactional liquidity gets taken, what do you expect? You expect a correction. That's why we call it correctional liquidity. All right. So we have another one, the range liquidity. This one is referred to as the internal. Is usually the internal liquidity, right? Is the internal liquidity. Okay, some people call it the structural liquidity, right? So I don't want to go into too much terminologies because I'm not sure how much exposure you have with some of these terms so that it doesn't confuse you. But what I want you to understand here is that is the liquidity that is found between, you find it between 2 swing points. 2 swing points. Well, what I mean points is like high and low. Oh. Right, what I mean by swing point here is high or low. All right, so if the market is moving between these swing points, any liquidity that happens here is called, anything happening inside here is the range liquidity or structural liquidity. All right, it can be a basic type of liquidity, meaning it's just a pullback, right? It can be double bottom like this, right? It can be triple, it can be trend line, it can be anything, right? You get the point. Okay, so it's the range, it's inside, it's the structural, all right? And then you have the expansion right? Expansion is, it's more like trend line liquidity, right? But it's slightly different, right? It's the type that most people call inducement or engineering liquidity. All right, all of these are the names that they call it. If you're a smart money person, you will understand what I'm saying. It's not difficult, right? So what we're saying is, imagine if the market is moving, in a trend line like this, right? Why we call it expansion is that this is a channel, right? I have a channel here, a line above and a line below, right? That the market has been respecting, bounce, respect, bounce. Now, if the market comes back here, we expect the market to bounce, but it doesn't bounce. What does it do? It pulls lower before going higher than this high. So what do we call this? You can see that these two levels that were equal, they will not be equal anymore if I'm to draw a trend line. What will I do? I will now have a trend line that looks like this. You see it? So what has happened to the trend line? It has expanded, right? So that's the best way I can explain expansion, right? So this expansion, right? It pulls out, it takes you out, and then it continues. This is called the inducement. All right, this is called inducement. What is happening here? It's very simple. It's liquidity run. It's a liquidity run, right? Why is it a liquidity run? Some people think that the market is going to bounce on the trend line the third time and continue, but it doesn't bounce. It now behaves as if it wants to break out. Look at what I'm saying here, right? They expect this thing to bounce, right? And then it comes back. Instead of the thing to bounce, it doesn't bounce. What does it do? It breaks out. People say, oh, there's a breakout too, right? There's a breakout. Let's trade the breakout. And then what does it do? It goes back. They say, oh, there's a retest. They try to sell the retest. It doesn't go. It continues. What has happened? A lot of money has been taken, actually. A lot of money has been taken. Money has been taken here. 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 On the buy, on the sell, on everywhere. Money has just been taken, right? So that's why we like this to be the introduction to our swing level, all right? Because once one level gets swept and there's a break of structure, this level looks solid because there's now intentionality, there's purpose. So what we're looking for is we want to see, oh, is there somebody who's going to take an SL? Is there a place where the market should return to impulse here? An important level here. So when we see all those things, yeah, we can enter here and expect the thing to give us at least 1:3 on the reaction. All right. So these are the types of liquidity. All right. And why I'm showing you all this type of liquidity is because I'm going to use it to explain the movement of price. Okay. I'm not going to stay long on this particular call. All right. Very soon, I'll start to wind down, right? See, why I'm explaining all this liquidity thing and telling you about all this is because I want to show you, if you understand why price moves from point A to point B, why, right? Why? Of course, there's the why, there's the where, there's the when, all these things. These are all around liquidity, right? If you understand this thing, your interpretation of price will be better. It will be better, and it will stop you from making a lot of careless moves. All right? And it's the same thing I'm teaching you is applicable everywhere. Right? It's applicable everywhere. Wherever you see it, as long as it's the price that people are transacting, liquidity is there. Okay, remember what I taught you some time ago. I told you that if you're designing a strategy, what you want to filter out on your strategy is the condition of the market, the direction of the market. And then somehow you want to see what? Liquidity. You want to see liquidity. It's very important in your strategy, any strategy whatsoever, right? And then the next thing is your entry. These are the 4 conditions that a good strategy should have. You must see the liquidity. If you don't see it, you are the liquidity. If you're not seeing it, you are the liquidity. I can guarantee you. If you take a trade and you cannot see who is getting an SL, whether it's a support and resistance guy, somebody may be planning to take a support and resistance like this. Is it not? Somebody may be planning to take a support and resistance. Like he draw this line and say, oh, this support and resistance, right? If he has not taken an SL and you try to buy, if he has not been stopped and you try to buy, you will be stopped. You'll be stopped. Right? You will be stopped. You need to look left and say, okay, somebody is trying to buy support and resistance here, and the market has stopped that person. That makes this play stronger. All right. So see, how does price actually move from point A to point B? There's something we call the external liquidity and the internal. This is a reversible reaction. Some people say, "Biko, don't tell us chemistry here. Don't enter chemistry." So this is a reversible reaction between the market. See, price will move from external to internal, and I'm going to teach you in such a way that it will stick with you for the longest. See, on the external liquidity, what do we want to see? We want to see buy side liquidity or sell side liquidity, is it not? And we also want to see old levels, right? Old swings especially, because we told you that every swing has what? Liquidity. So all the swing to the left, right? We're looking to the left. These are the externals. Then on the internal, we have, what are they called? Like the FVGs, right? The FVGs. And remember, I told you a lot of, I don't know if it was you I taught all my students now. So, but fine, FVG. You know what FVG is? FVGs, they are imbalance, right? They are imbalance, right? So if you don't know what FVG is, just do a quick research on that. You'll see it. It's just the imbalance between three candles, right? If I have first candle here, I have second candle here, right? I have the second candle here, and I have the third candle here, right? See, it's a gap. So where's the gap? Between, this is candle 1, this is candle 2, and this is candle 3, right? So this is candle 1's low. You can see candle 1's low here. Is it not? You can see candle 3's high here, right? See it. What is happening? The wick here did not touch the wick here. That is why we say it's a gap. You understand? So that this is an imbalance. So these are the internal ones, right? So the market is always moving from external to internal, from internal back to external. That's how it's moving. And then, of course, you have, maybe some form of basic liquidity can be referred to as internal basic liquidity, right? Like just maybe the type you call inducements, right? The market is moving from the internal liquidity, which is the inducements, to the external liquidity. So it's either going to fill a gap, it's going to take out a high or take out a low, and then run back to external liquidity. All right. So remember when I taught you the range, I said the range kind of liquidity is, see, this is a swing high, is it not? This is swing high from here to here. Everything happening inside here is a range, and this is an inducement. All right. So this is a range type of, or a correctional, I beg your pardon, a structural liquidity. All right. So this is internal. This is what? This is sell side liquidity, and then buy side liquidity, right? Now, what's happening here is market is pushing, coming, it plays with everybody here. It takes enough money here, and then it chooses whether to go to the buy side or the sell side, right? It chooses whether to go to the buy side or the sell side. Okay, so it's either going to reach for this high or is going to reach for this low after it has taken money inside. After the market has taken money inside, it's either going to reach for the buy side liquidity or the sell side liquidity. All right, so please take note of that. Okay, so it's going to reach for right now. The question now comes. Sorry for that. So the question that comes to your mind now is which one will be taken? Are we going to take the sell side, or we're going to take the buy side? Right? Which one are we going to take? Is the market, after the market has taken the inducement inside, is it going to, if now when I say inducement inside, I'm talking of either the fair value gap or the basic liquidity. Is it going to go for the buy side liquidity, or is going to go for the sell side liquidity? Which one? Now that's where you now have to understand the trend, right? It's the trend that would determine that. Okay, this is a structure. All right. So if the market is in an uptrend already, you know that it is the buy side liquidity that will be the market will move towards when it has taken an internal liquidity. If the market is in a downtrend, it will take the sell side liquidity after it has taken money inside. All right, so I'll show you in the chart so that you don't get confused. All right. So another thing I need to make you understand, because you need to understand the movement is, or you need to understand what displacement is, right? There are two things you need to learn here. Displacement is an aggressive break, right? It's an aggressive break. You know, when I say displacement is an aggressive break, what I mean is it is an impulsive break. Right? When we say something is impulsive, right? See, when the market is going, right? When the market is going, if there's a high, right? Let's say the market goes down, comes back up, and then starts to go back down again, goes back down, right? Look at here. What you have here is what is a displacement. Why is it a displacement? Because the market used, full-bodied candles to break a low or a high, right? A low or a high, right? So there's a structure break as a result of, big-bodied candles. We call them elephant bars or marabozus, whatever you want to call them. Just know that when you look at them, they are attractive. You see that there's pressure here. There are gaps, right? Imbalance. Right, there are imbalance, right? You can see, the market is moving with intention, right? It breaks the level and then it goes. Now, what is the opposite of displacement? So you know what displacement is now. So it has gap and then it breaks a level, right? It closes, right? It closes above a structure. So what is important to note here is that it closes above or below a high or low, right? So below or above a high or low, it will close. Now, the opposite is failure to close, which is FTC, right? These two concepts are what you need to understand the draw on liquidity in the market. What you need to understand how market is moving. You need to understand this, okay? So failure to close is the opposite, right? It's a failure to displace, right? Failure to displace. So what do I mean by failure to displace? Imagine if there's no body close here. Instead, the market came here, used the stopped here, used wicks. This does not exist. Use wicks, and then it continued to run back. What will you call it? It's a failure to close. Let me go into the chart. There's no need wasting time because I'm running out of time already. Where do I start from now? Okay, I'll give you. Let's use. What market is this? Which use NZD? No. Okay, let's just use EU because I believe most people are using the EU, right? Now, what I want you to see is observe what I just taught you. Market is moving from internal to external, internal to external, internal to external. This is very important. If you understand what I just said, it will go a very long way for you, right? So remember I said it goes from external to internal. What is external? External is buy side and sell side liquidity and an old high or old low. What is internal? Internal is either an inducement or a fair value gap. That is internal. So the market will take this one, go for up or go for down. What will determine whether it will go for up or go for down is the structure. Okay. Now let's just take it from anywhere, right? Let's take it from anywhere. The first thing we're seeing, there's a good move here. Why is this move moving, right? Look at it to the left. There's been liquidity sweep. You can see this market came down, swept the liquidity, and then pushed up. There is intentionality, right? So, I mean, there's intentionality. It's not a random move, right? So you must be able to distinguish on your chart which one is a random move and which one is, an intentional move. Why is this one here? Look at this one. Why is this one here not important? There's no liquidity sweep here. Look to the left. There's no liquidity sweep on anything here. So this is not important. If I buy a pullback here, I will get stopped. Look at it. Sorry about that. right? If I buy a pullback on it, I'll get stopped. Why? Because it's a random move. It just the market just moving, right? There's no intentionality. If something was swept here, it would know that, oh yeah, something has been swept, a high or something has been swept. That's why the market is pushing. Now we can start to position ourselves for inducements and buying pullback. If you buy a pullback on this trade, you will get stopped out. Look at it. Now that's just a simple example. Now what about this one? You can see this was taken. Trendline liquidity is here. It has been taken. This level took it. Right, this level took it. I don't know why my mouse keeps jumping. Right, see here, it takes it, it pushes up, break of structure. Now we can buy pullbacks, we can buy into inducement. So, but that's not what I want to cover. What I want to show you is something that, look at a gap. This is a gap. A gap is from here to here, there's a gap, right? So what does the market do? It will fill up that gap, and then it will reach for what? Transactional liquidity. So from internal to external. So after this gap has been filled, what does the market do? It pushes up. So you can anticipate that immediately after this gap is filled, we expect higher prices. Is it not? Now, after this one, what happens? Market goes to the external, right? Is there a break here? There is a break. So there's a displacement here. If there was no displacement, take note, if there was no displacement, meaning wicks, candle wicks, the market returns back. It will reach for something lower. But if there's displacement, now the market will go up. Why is it turning from here? If we look to the left, I'm sure we'll see something somewhere on the old high, old low, somewhere, somehow, where it is reacting from. Now, it turns from that point and fills up the gap here. Let's see if we can spot a reason why this market is reacting from that level. Okay, so there's, you know what a volume imbalance is. You can see that there's a volume imbalance here, right? There's a volume imbalance. So this is an old level of importance. The market gets to this point and then it reacts, right? It reacts. That's why you see, because if not, I mean, is the market going to go forever? No. When it gets there, it reacts. Now, because it's reacting from here, what do you expect it to do? It will fill up the gap. See, between this candle and this candle, there's a gap. It will return back and fill it up, right? It fills it up. After it fills up that gap, what does it do again? Internal liquidity has been filled up. I told you it's a reversible circle. It goes from here to here. Why will it go up instead of to go down? Because the flow, the structure is a buy structure. It's a buy program that is in play. So a buy program is in play. The market will fill up the gaps and then push higher. Now it goes to take transactional liquidity. What is happening? We see failure to close. Eventually we see a follow through bar, which is a close, right? Market goes up, it comes back, fills up something wherever here and then goes again up. Now, why did it turn from here? If we look again, we're going to see that it is reacting to something on the low, old high or old low. Market is moving because something is making it to move. Everybody's selling this. This is a supply zone. Everybody's selling this thing. So we should expect some form of reaction from that point, right? And then you can see how the market is. This is a daily time frame, by the way. So you can use this to know that, okay, because there's a level here, I expect transactional liquidity, the breakouts to stop. And then after the breakout stop, what does the market do? All it has been doing so far is creating what? Liquidity. So it will come back and then take out all those liquidity. Even as it's doing that, what is happening? It's still reaching for internal, right? It comes back, it takes this guy, takes this guy. What does it do? You can see the wick here trying to reach to the gap here. There's a gap here. So it goes back to that gap. Then after it goes back to the gap, what will it do? It will come back to external again. Goes to external, fills up external, goes to external again, keeps pushing. Now, after this point, what do you expect? See, this one has been swept, is it not? See here, you see it. Immediately it sweeps it. What does it do? It will go and fill up internal, fill up gap, take highs or whatever. After it has taken enough of internal, it will come back again to external. This is how the market is moving. This is just a random chart I'm taking, right? You can see it's not even a clean one. I can just bring out a clean example and show you everything. But that is, at the fundamental nature, that is what is happening. The market is simply filling up gaps and taking out external highs. Go and read your chart. That's what is happening. Everywhere I can go on and on. From here, what are we reacting to? We are reacting to this level. Immediately market reacts to that level. What do you expect it to do? It will fill up gaps inside. You see, it will fill up gaps. Now, as it's filling up this gap, there's a gap that is created here. Immediately it reacts to something up here, right? You can see these highs have been raided. Immediately you raise the high, failure to close. It will come back and fill up these gaps. Immediately it fills up the gap. What does it do? It will turn again and reach for the high. That is how the market keeps moving. It fills up the gap, it takes a high. It fills up the gap, it takes it takes the low. It fills up the gap again, it takes the low. That's what it keeps doing. That's how you understand order flow. That's how you understand how market is moving. So if you understand that, okay, we have taken a low, now we are coming back to fill up a gap. You can tell that for the next couple of bars, in the next 2, 3 bars, 4 bars, we are expecting green candles, white candles in this case. We're expecting buying because there are gaps to be filled. Once the gaps get filled, what do you expect? You expect the external to be taken. That's how the market is moving. That's how the market is moving. How does it interact with the previous, old highs, old low? What you want to see is a sweep. Failure to close. Displacement is, if we are going to break it, we are going to see body close, right? Look at this one. If we want to break and continue, what we will see is a body close. Even if the first one weaks like this, the next one is going to be a follow through, which is a body close that shows you that it's reaching for another one. It's not going to react to this one. It is reaching for another one. So you are now telling yourself, okay, where is the next person? Is there a gap? Is there something? Is there a level? If there is none, you have a clear zone. You buy for the next couple of days. Look for buying setups for the next couple of days. If the thing reacts like this, you see what? Failure to close. See it, failure to close. What are you going to do? You sell because you know it's going to reach for this guy. It's going to reach for this guy. After it reaches for this guy, it reacts to the gap. It reaches for the next person. It comes down again. After it comes down, it reacts to the gap. Who is this guy? He's reacting to somebody. I already showed you. He's reacting to somebody here. There's something here. See, there's something here. It must be reacting to something. That's how the market is moving. Many of the time, you don't know what you are doing on the chart. You don't know why the market is moving. You don't know what is happening. That's why you take too much stop loss. Because if you understand that, okay, we are in a sell program or we are in a buy program, it's easier for you to look for those setups. Then maybe you get stopped because of volatility. That's okay. Or because you didn't pick the right reversal point. That is okay. Right? It's when you keep practicing, you now know, okay, where is the correct points for me to pick so that I minimize my stop loss. I can go on and on with this example, right? So you can see all the things that I showed you. Look at, this is what an inducement. What does the market do? The market sweeps this high, makes people think that it wants to buy. And then what does it do? It sells. It sells. Stop loss is taken. People think that, oh, it's a buy. We are now in a buy scenario. It sells. What has happened before this one? The same thing. The same thing. Look at the inducement. Everybody's stop loss is here. They are trying to sell the market. The market's not going to sell because it needs more buyers to come in. It needs buyers to come in. So what will it do? All the people who are selling before, it will stop them first. After it has stopped them, it will now, in the course of trying to stop them, it is printing bullish scenarios that will make people say, oh, this is exhaustion bar. Oh, this is continuation bar. Oh, now we have buy. Everybody will buy. Put their stop loss here. It will stop them. That's what we are saying. So if you are smart money, your job is to be able to look at the chart and say, okay, how is the market moving? Where are the people who are getting stopped? Where is there like a buy scenario that shows that the market is going to buy? Yes, if there is, where am I going to enter from? From the area. You're not looking to be the guy who catches the liquidity. All right. Don't play the you don't have your $100 cannot catch liquidity or move the market, right? Your $100 can't do anything. It can't do anything. So just be humble. Don't look for picking bottoms, picking tops, and all those things. What you want to see is let the thing be clear. Intentionality. You want to see it is clear, is obvious. If it is not obvious, it will not work. It will not work. If it is not obvious, it won't work. All right. So it's the same thing. This is another area now. This is another area. It's the same thing. Look at it. Their stop losses are here. These bars are introducing buyers. This thing that you're seeing as a week was bullish. People were buying it. It takes the stop losses and then breaks everybody down. Take everybody's stop loss. It's the same thing, right? That's how the market is moving. It's taking people, it's taking the liquidity, it continue. It take the liquidity, it continue. It take the liquidity, it continue. When it finish, it turns. And it's the same thing that is happening. From wealth, it fills up the gap. Look at it. There's a gap here. It fills it up, it goes down. Takes this one. Comes back, fill the gap. Goes down, takes this one. Is it not? Come back, fill the gap. Any gap there, it will fill it. And go down and break, right? Until they start to get absorbed. There's a gap here. We're not seeing, the encroachment thing where we are looking at about 50% of the gap to be taken, right? Now, the gaps are being absorbed. The gaps are being absorbed. You can see the body clues. The gaps are being absorbed. That's an early indication that there is, there's a bump ahead. There's a bump. Then we confirm this by looking at the other levels to see if there's something important that the market is reacting from. Why are the sellers absorbed? Why are they getting absorbed? This is a gap. They are getting absorbed. Why are they getting absorbed? What we want to see is wicks, 50% of that gap. Wicks, rejections, showing that there are sellers here. There's like a catapult. They are firing this thing back. You see it. Look at it. They are not getting absorbed. You see them? They're not getting absorbed. All the gaps, they're not getting absorbed, right? They're not getting absorbed. It just touches it and runs away, right? So you know that, there's a gap we're going to fill. After we have taken a stand out, there's a gap we're going to fill. Or there's a high. Or there's something we are going for. Internal. So internal to external. Internal to external. Internal to external. That's what happens, right? Internal, it goes from, internal, it goes to external. That's what is happening. Why is it bouncing from here? There is something he's reacting to. It's simple like that. There's something. There must be something he's reacting to. You must understand how price is moving. My goodness, I have forgotten. I have a giveaway post to make. I should have set an alarm. All right, so I think I'll stop here. I'll stop here because it will. Sorry, mate. Too late. So I'm sure it's making some sense to you what I'm showing you, right? So I think I can stop here. I can stop here. Now, how do you apply what I've taught you today? How do you apply it? Go to your chart. Look at the examples I've given you. I've taught you failure to close. I've taught you displacement. Is it failing to close? If it's failing to close, it's reacting to something there. Is it actually after transactional liquidity is taken now? What is happening? We are expecting market to come and fill up all the gaps inside. That's what we're expecting. That's what happens. And that's how you can read. Even down to where we are at now, you can read it. There's a gap. You fill it up, it will continue. That's what is happening. Okay, so you just look at it. It's filling up the gaps. It takes it. It's pushing. And then if it's not going to push, if we see that they are getting absorbed, if these guys are getting absorbed, then you know that we're expecting lower prices. It's simple like that. Don't make it complex. It's simple like that. All right. So from that point, what do we have? So the main thing I want you to understand, if you're an intraday trader, how you can apply some of the things that I've taught you is, there is a real liquidity and a fake liquidity. I'm not saying this to confuse you. What I'm saying is really, really very simple. It's basic. There's real liquidity and there is a liquidity that is not real. How do you know a liquidity that is real and a liquidity that is not real? That's where, factors like time come in, right? Time, let me show you what I mean, right? So if we have our fuel, right? Our fuel is liquidity, right? Money. We now add time to it. What is this going to give you? It gives you what? Intentionality. This is what I'm teaching, right? Intentionality. It's intentional. There's purpose. That's what I'm saying. There's purpose, right? See what I'm saying again. If liquidity is raided, of course, what I mean by fuel here is a raid. I've showed you what a raid is. When we see failure to close, there's a raid. The market, if the market is supposed to go, it just, there's a low here, and the market comes weeks above the low, right? Like this. What is it? This is a raid of liquidity. Now, if the market starts to push, how do we know whether this one is real or not? How do we know if it's real or not? We now have to look at the time. This is where I'm talking to day traders now, guys. I'm talking to day traders. We look at the time. If you're a day trader, you have to look at time, right? Because market is moving. See, how does the market go throughout the day? It goes from volatility to low volatility to high volatility. That's what happens. London gives you volatility. London, that afternoon period, the volatility usually will drop. And then New York will come again and reintroduce volatility. All right? So if we're talking about displacement, impulsivity, strong move, we can't talk about strong move when there's no volatility. So it's volatility that will bring it. What will bring the volatility is the session. What will bring the session is the time. So you look at the time for New York, for London. London Open, I think is 1:30 Nigerian time because it's 8:30 New York. So it should be 1:30 Nigerian time. And London is mostly 7 o'clock or 8 o'clock, depending on the +1 factor for London, right? So it's 7 o'clock or 8 o'clock in Nigeria, or 1:30. Is it 1:30 or 2:30? 2:30. 7 o'clock or 8 o'clock, 1:30 or 2:30. You will not look for it. When New York starts, you will see the craziness in your chart, okay? So what we're saying is, see, if there's a double bottom can be from anybody. Is it not? It can be from anybody, right? Now, double bottom, and then we're seeing that double bottom gets raided. And, there's a displacement. We have liquidity swept. Is it not? We have liquidity swept. So, is it safe to say that this displacement is a good one? Yes. Why? Because, no. What I'm teaching at this point now is that if this displacement is happening at the London, right, is happening at the London, you know that, yes, you are, you have a better chance of, getting a good move here, right? Because London is going to give you a trend. New York will also give you another trend because they have volatility. They have the ability to give you a trend. All right. So you're trying to jump in on the pullback of this trend. Now, this is the raid. It has intentionality. That's what we're saying. This is for day traders now. Now, what if I see a liquidity sweep that is happening before London Open? It's fake. It's fake. This is where I want you to see the distinction now. It's fake. Why did I say it's fake? When London Open, it will come back. Let's say the double bottom has happened. It's not yet London Open and we are seeing something like this. This is fake. I promise you it's fake. When London comes, it will sweep it again and go. That's why you see you get an SL. Why? Time. Is that okay? Time. All right. So this is a time. It's a London. London has come in. Now London is going to take, that thing that looked like, the people are now saying, there's liquidity sweep already. Let me put my stop loss. Let me put my order block and all these things, right? It will take them. Why? Because they have fuel. They saw fuel, but there was no time factor. Who is going to move it for you? There's nobody there to move it. So somebody has to move it. So if that person is not there to move it, then it's a futile attempt, right? It makes no sense. You will lose. Is it that it cannot happen that this will work? Yes, I told you there's a 20% time when the market will allow you to do that thing that you want to do. But the mass is not in your favor. We are playing a game of edge. The mass is not in your favor. If you keep doing that, you will lose money. All right? So I hope it makes sense. So what if it was maybe you have Asia, you have New York, London, Now New York comes, New York raids the high. If New York reads the high of everybody here, this is a good read. It's a good read. Why? Because New York time has come. New York time has come. Is it not? New York time has come. So we agree that this is a good read. But what if New York time has not come? Then that period when there's low volatility, something comes and sweeps like this, and then you now say, oh, there's the liquidity sweep, I can see it, liquidity sweep. You will lose money because New York will come and take everybody out. So that's why we say, in order for you to know that it is real, two things. See, you must see the fuel, and you must see the time. And it's not just session that introduces volatility. Do not forget the news release, right? Don't forget news release. If there's a news release, there's a chance that volatility will be introduced into the market. If London will open by 8 a.m., if London will open by 8 a.m. and there's a news by 8:30 a.m., what do you think is the smart thing to do? Are you going to use this time or this time? You use this time. This one is the fake one. Because the London traders know that there's a news by 8:30, they will wait. So London will come and give you the fake move. You now jump in, and then before you know it, the team will come and sweep everybody and sell. This one will happen by 8 o'clock. This one here will happen by 8. This one will happen by 8:30. Why? Because there's news. Is that okay? So this is time factor. Time factor. We're talking about session. We're talking about news releases. All right. So take note of it. It's the same thing in London. Let's say there's a news. For New York. If there's a news, New York open, maybe same time, then that is good, right? But what if it is 1 or 2 hours after New York opens, right? Which is not likely. I'm just using as an example, right? So what if the news is coming maybe later, like 1 hour later, right? There's a news by 2:30 p.m., right? And then maybe at 1:30 p.m., there have been a liquidity sweep, right? What is going to happen? This liquidity that swept will be swept. All right, so I'm just opening your eyes to this. So these are some of the ways you can apply some of the things I've taught you. Understand the concept you are trading. Understand that when you understand the concept that you are trading, it's easier for you to make money. If you don't understand the concept, you'll be making a lot of mistakes. You claim to be a smart money trader, but you are not smart. You see, you're not doing smart things. That's why you take many SLs, too many SLs. All right, so I'll stop here, and I wish you good luck. So look at how you have been approaching liquidity, and then see what I've taught you today, and then see what works for you. All right, so there are many patterns that works with liquidity, like the one I show you. This is liquidity here, right? This is a selling pressure. So if we have a good order block here, right? Something that has swept the low, that has displaced, right? Broken structure. As long as it has, somebody's SL has been taken by that order block, it's a good one, right? So we want to use it as a return to impulse for us to buy, right? This is a simple liquidity setup that you can use to make money. All right, so go and do your back test, and I wish you all the best. Those of you who may like the idea of joining us, we've got a decent group where I have most of the courses are on display here. I don't know what's happening, but I was going to show you. So I think my mouse, okay. Oh, I hope I am still audible, because I'm hearing pam pam pam. Okay, so so I was just going to show you. I have all the courses. I've taken everything on SMC. You can join the other guys, and then let's make money together. In the next video, I'm going to teach what. I think I'll make a poll on the group asking for what you want me to teach next. All right. So why I'm doing this is I'm giving you the knowledge so that you can you can apply it to what you're doing and then start to see some money. If you can start making some money with it, it's easier. Then maybe you can now sign up for the course, and then you see some, some other things that I teach, that I talk about, right? So I'll end it here. Thank you so much for your time. It's been a lovely time with you. Do have a wonderful week. May the peeps go with you. I will try to send in more videos more often going forward, and hopefully the peeps will be with us. Thank you so much for your time, guys. Until next time, do have a lovely time, and cheers, guys. Bye.